Welcome back to another Market Open live stream. Today we've got former economic advisor for Donald Trump, Gary Cohn, suggesting everything is back to normal in the economy. Yeah, the economy is completely back to normal. We thought that was really interesting. I was like, okay, I mean, I'm trying to understand here that it's a good thing, but interest rates are just a little bit higher, and prices are a little higher, I guess. All right. Uh, I don't think Donald Trump will say that today, though, because that would definitely not be good. Oh, hold on. Why is there an echo? What? No, shouldn't be an echo. Do you have two videos up? I see some people. Is everybody okay? There we go. We should be okay. So somebody complaining about an echo might have two videos up. They must love the live stream so much. They must love it so much they have two videos up. But anyway, so I don't think Donald Trump would like to say that the economy is back to normal, because that would not be good for him being able to get elected. Because I think the best thing for Trump, hate to say it, but is a continued pessimistic outlook on the economy. Individuals and consumers, as surveyed, obviously very upset with the economy right now. That's showing up in polling. General election, Trump v. Biden, you got 4 points Trump, 6 points Trump. Here's 1 point plus Biden. But usually what we're seeing +2 Trump, and these are from all the sources. I mean, NBC, The Messenger, Emerson, Morning Consult. It's really interesting. And a lot of it, I think, is driven by this frustration over what's going on in the economy now. But it'll be interesting because, as we've seen, we're starting to see some pullback in yields and therefore rates. For the 10-year Treasury is sitting down 4.6, looking at 4.29. This is right around where I actually went long with TMF. If I remember correctly, it was right around 4.3, and that's where we sit right now. Boy, I've been through a little bit of a roller coaster the last few months on that, because they basically went the opposite way for the last 3 months. I mean, 3 months ago, we're September 18th. We're sitting somewhere around 4.3. Yields skyrocket to basically 5%. And then they come straight down from there. Now the question is it because the Federal Reserve that these yields are starting to come down? And the answer appears to be yes. A lot of people believe that because the Federal Reserve is via Waller now suggesting that the top may be in, and it may be time to cut rates next year if inflation keeps coming down. It may be time to cut early next year, mostly because if they don't cut, then they're actually continuing to tighten. Remember how that works. If their goal is of having a real rate of X, whatever that is, and then they raise rates to get the real rate to that level, well, then as inflation falls, that real level of restrictiveness actually increases if they keep inflation, if inflation keeps falling, because it's the spread between those two that the Fed is really trying to, get to a restrictive level of. So this is the failure that we saw with Arthur Burns back in the 70s. This failure to actually get interest rates above a sufficient level to actually bring inflation down, or actually prove that the Federal Reserve was in control. Without the Federal Reserve proving they're in control, you lose inflation expectations, which obviously you also don't want. Governor Waller said his exact quote was, quote, "For several more months, if inflation continues to, quote, cool for several more months," I don't know how long that might be, 3 months, 4 months, 5 months, "that we feel confident that inflation is really going down and on its way, then you could start lowering that policy rate, just because inflation is lower. But again, that's if inflation actually continues to come in the way it's been. So who knows if that actually happens? Because quite frankly, all it really takes is one inflation report to miss, and whoosh, everything will just pop right back up. Okay, we just got what? GDP annualized quarter over quarter? Are you kidding me? 5.2% just came in. Retail inventories were expected to come in at 0.6, and those were revised to 0. They actually came in at 0. GDP annualized, that's for the third quarter. That's that 4.9 we got. It actually got revised up from 4.9 in the preliminary to the final now of 5.2 is the final read. Wow. Personal consumption coming in 3.6 versus 4.0 expected. GDP price index, not so great, coming in at 3.6 versus 3.5. Again, that's Q3 though, so we're looking back to we're looking back to Q3, and core prices actually came in lower per that Q3 GDP, coming in at 2.3 versus 2.4. I don't know how much of a reaction we'll actually see from the market. Oh yeah, it didn't care. If anything, it actually went up. Wow. That's really interesting. There's the market for you, telling you we don't really care about your Q3 numbers. In fact, yay, Q3 was even better than we thought it was. Let's go. Yeah, that's okay. Okay, all right, that's awesome. So now we have the Fed's terminal Fed funds rate, discount rate. That looks like it's sitting at 5.33. Again, suggesting the peak is in. Any number under 5.375, which is where we sit now, suggests that we will not go any higher. You have the world interest rate probability curve for the first time actually showing no more rate hikes. That's really interesting to see. We've seen this world interest rate probability curve, the WIRP, for quite a while. We've looked at it and watched, and it always had some form of other rate hike in it, another little bump before we started seeing the negative lines. Quite nice now to see the WIRP flat where we stand and down from there. Look at that WIRP, the WIRPy doodla, straight down, baby. That's all we got ahead of us now. At least that's what the market's pricing in. We don't know if that's certainly true. So take a look at this. This is starting to price in cuts. We've got about 0.5% being priced in for March. Sorry, not 0.5%, a half cut. That's how they do this. So March is pricing in half of a cut. A full, and these are 25 BPs, a full cut is priced in May. So one full 25 basis point cut. Yeah, confusing. You have 3 25 basis points. So a 75 BPer priced in by September. And then by January, you have 1.25% or 5 cuts priced in. Huge cuts, says Sender. Let's go. Exactly. Somebody here says, not good. That means more inflation. Not necessarily. You know, I'd really like somebody to prove to me, which has not happened yet, that a stronger economy equals more inflation. That connection is not valid. Or if it is valid, I haven't seen proof for it. Because to me, it looks like the U.S. economy boomed for 40 years after Paul Volcker, and we created the strongest economy in the world, one that actually generated deflation. And the only reason we didn't have inflation was because the Fed likes printing money. So if it weren't for the Fed, prices would just be going straight down. So I don't see a strong economy creating inflation. That's probably what is going to lead a lot of people to be caught offsides with their investments going into the next few years. I really believe that. I think over the next few years, a lot of people are going to start realizing, what the heck? How come the economy is doing better, but inflation is going down? That doesn't make sense. And that's because we were trained in COVID that if you have a quote unquote strong economy, which was total BS because it was just, money printing, and a substantial amount of that. It's money printing and then helicopter money. It's like you print it, you go pick it up with the helicopter, and you just give it to everyone. Surprise, surprise, it feels like you have a strong economy then. And so the feeling of a strong economy has become associated with inflation. But that's not true. It wasn't the strong economy that created inflation. It was the lack of supply chains to be able to support all the helicopter money that we printed. So of course you get a temporary price surge. So I don't know. I'll probably have to say that like 50 more times. I remember a year ago it was having to explain that disinflation does not mean deflation, and then we finally caught up with that, and now it's going to be that a strong economy doesn't equal inflation. We'll see what happens tomorrow. What we have to explain over the next few years, which is okay. And it doesn't mean it's guaranteed to be right. It's not. Yesterday in the Meet Kevin podcast, if you haven't been watching that, make sure you go check out the Meet Kevin podcast. Yesterday we talked about how science, I think people think, is like math, and so that's why people are like, oh, trust the science, and other people are like, what do you mean? That's what they said about the COVID vaccine, right? And so science, Mikey had such a great explanation for it, as this, a process of testing a hypothesis and then hopefully getting closer and closer to the truth. Math is very different because math is, we have come up with laws basically where things function over and over and over again. 2 plus 2, for example, right? So we get these facts. The economy is still much more associated with economic science, so basically theory that gets tested, than guarantees. Anyway, all right, let's take a look at the 5-year break even now that we have a plummeting 10-year. I'm very excited about that. Oh, wow. Oh, that's beautiful. We are at one of the lowest places on the 5-year break even that we've been all year. Look at the 5-year forward. 5-year meet science. Yeah, exactly. Nobody knows science better than I do. Not black doesn't equal white. Ooh, I like that line. Ooh, somebody wants to know, what about HouseHack? HouseHack's killing it. Like, for how quickly we are getting like the team up and running, and the everyday micro adjustments we make to run this company more efficiently. It's amazing. I can only imagine what happens to companies who don't make constant little adjustments to make their companies more efficient. I think that's how you end up with like a GM. Oh, although GM was a good company for a long time. They got to step it up again. The stock's popping a little bit today because they are reintroducing guidance and dividends, trying to give investors some hope again. Hope goes a really long way. Here's the 5-year break even, by the way. Look at this. Let's go grab this, a line here. Ooh, I love it when we pull up the lines. Oh, preview. What is this nonsense? Oh, how many times is it going to take to get to the bottom of the line pop? There we go. Look at that. We're sitting on top of that line right now. I don't know if I keep it straight. It's the downside about preview. It doesn't lock to straight. I believe that's roughly straight. As you can see, the 5-year break even is great. This is fantastic. So I like that. Okay, so Rip Munger, indeed. Honestly, I'm very worried about Warren Buffett now. Usually when somebody loses a lifelong partner, like Jimmy Carter, frankly, it's not good. You lose a lifelong partner, it's usually not so long for the other person to go bye-bye as well, like 6 months, which is horrible. I mean, Buffett's 93, Munger was almost 100. He was about to turn 100 in, 33 days or something like that. But I hope Buffett gets through this. That's got to be such a heartbreak for him. Yeah. I know he looks put together when he releases a statement, but that's like his office releasing a statement. So I'm sure he's crushed. There we go. I think it's blowing right at the back of my head. It's killing me. All right. So then we have, how about Intuit? And yeah, somebody here is asking about CrowdStrike. So CrowdStrike came in with 82 cents of EPS versus 74. They also came in with a beat on Rev at 786 versus 777. And a little bit of a beat on forecast for the full year. Also, teeny tiny beat on the fourth quarter forecast. So, good. Slight beat across the board. Let's see how that's doing for them. Okay, come on, Weebo. Oh, wow. I would have expected a little bit more of a movement here. Only about 2.86%. Another company that reported yesterday, Intuit. This is a company I've really been eyeballing for a long time, but I wanted more of a sale. I'm just not getting it. Let me see here what's going on here. All right, so Intuit, Q2 rev 11 to 12% up. Their Q1 rev came in at a slight beat. What is that like? It's about a $10 million beat. 2.98 billion versus 2.88. Q1 adjusted EPS $2.47 versus 198. That's great. And their forecast is roughly in line. Okay. Let's see here. So pretty in line, slightly to the. Okay, well, that's kind of how the stock is moving. See, that's what you're supposed to see. The stock beats by a tiny little bit, like 1 to 2%. The stock goes up 1 to 2%. This insanity that we've seen in this market where it's like stock beats by 20% or whatever it was, and stock comes down 20 points, like NVIDIA. It's insane. Anyway, all right. So let's take a look at some of the sticks. Foot Locker up 13%. What? Oh, I didn't know their ticker was. I guess that makes sense. They got FL. Good for them. That reminds me of Florida. I grew up in Florida. Okay, so Foot Locker says strategically entering India. Comp sales were negative 8%. They were looking at negative 9.88%. Ooh, I wonder if they did not buy back any stocks. I wonder if they are seeing deflation. Still sees ending year inventory flat. Oh, I can't wait to hear their earnings call. Actually, I may be able to get a live transcript. FL. So I have that on this computer. I have the ability to get live transcripts as they're happening. I just have to go to events, corporate events, under Foot Locker, and then I should be able to get conference call. Yep. Started at 6 a.m. Okay. All right. This is how we snowball. Okay, I got the whole thing. All right. Let's go. What? No word of the mentioned price? That can't be. Oh, that is a short call. Rate of sales lower Q2. Possibly depends, guys. Ladies and gentlemen, that concludes our today's call. This is a very relatively short call. They made a statement and they took a few nominal questions here. Doesn't seem like a very long call at all. How did they not mention? I mean, unless my search feature isn't working. Let me try. Thanks. Nope. The search feature is definitely working. Okay, so they did not mention the word price. They did not mention inflation. I don't have the word eco found as well. What? They kind of punted here. We do not have any view on the broader consumer at this point. Wow. All right. Well, that's not too useful. Boring. Foot Locker didn't really give us much in their earnings call. Okay. Well, that's boring. I will close that then. Goodbye, Foot Locker. Thanks for nothing, losers. Okay. To the downside, Affirm. Wow, Affirm's at 32. It went up another 11%. Holy smokes, it went up another 11% yesterday. Wow. Well, congratulations to anyone holding Affirm. Holy smokes. Remember, we were looking at, I mean, we've been watching this thing since, $8. But, well, and since obviously even before that. Wow, what a roller coaster that stock's been on. Okay. Then we have Open Doors up about 5. Boy, that's a volatile one too. Yesterday was open up 5. The day before was up 5. The day before that it was down. Enphase up 167, trying to offset yesterday. 1.4 on trade desk this morning. Pretty much everything's green. Tesla 125. A lot of green in the market today. All right. Let's see what they're yapping about over here.
Seasonal period, and we were right ahead of a massive yield surge. So not all of that is in place right now at the same price levels, although I do think the soft landing belief is getting in there. Take a look at the U.S. dollar index. It has been weak. That has been part of this story. Gold is higher as real yields have come down, as bond yields have sunk. And, of course, as we get past this idea that the Fed's going to be doing anything more except cutting next year, this basically is when the Fed first started raising rates in early 2022. So it's kind of almost a round trip. It's been supportive of that loosening of financial conditions. Another element of the market dynamic is a little bit of the spicy speculative stuff has started to jump in the last few days. GameStop, people talking about some of the EV names, Virgin Galactic, all the old ones. Well, take a look at the meme stock ETF, which is about to go away. Roundhill announced they're closing this in a couple of weeks because almost no assets under management, under 3 million. But it's tracked over 2 years exactly the ARC Innovation Fund, which has more than $5 billion in AUM. So I just want to point out that when you start to see the big percentage moves off the lows in these speculative names, this is where it's coming from. Okay, so you did also have that in the summer, but not even, even now, it's not really approaching. There's a little bit of a speculative froth that we got back a few months ago, Joe.
All right, Mike. Thanks. We do have the 10-year now above 430, so it has, 428.
428 was crazy. It's still a big drop from where we were. Oh, it's actually back to 432 almost. Charlie Munger, Warren Buffett's longtime business partner.
It bobbles around. Big deal. What do they say about Charlie?
He was about to celebrate his 100th birthday on January 1st. I spoke to him just 2 weeks ago for a special program we were planning to mark that occasion. Munger was a lifelong student, a voracious reader, trained in the sciences, but it turns out even Charlie Munger had a few things he wished he'd done differently.
I could have done a lot better if I'd been a little smarter, a little quicker.
What are you talking about? You've had success in everything you've done in life. What would you like to do differently?
I might have had multiple trillions instead of multiple billions.
Do you sit around thinking about this? What would you have done differently?
Yes, I do think about it. Yes, I think a lot about what I nearly missed by being just not quite smart enough or hardworking enough.
What would you have changed if you could go back?
Well, I'd go back and make some. Of course, it'd be a cinch to go back and do it, knowing what was going to happen now.
Yeah.
I would be the richest man on earth.
Charlie Munger is survived by a large family, dozens of
He doesn't sound good there.
We'll have a special CNBC program, Charlie Munger, A Life of Wit and Wisdom. That's tomorrow night at 8 p.m. Eastern Time.
That's sad. I'm actually kind of sad to hear that. That's not like like, oh, yeah, Charlie Munger. But, man, I didn't do good enough. I should have done more. Oh, that's sad. That's sad. So somebody here says it sounds better than Biden. Oh, my God. Stop. Oh, man. The Ark and meme correlation. Oh, heck. Isn't that what the Alliance saw when the Horde said LOL, and then the other version is BUR, burr, or is that, or did I mess that meme up again too? Like somebody, no, I guess that is somebody told me that was something else one day, but I'm pretty sure that's what the Alliance sees when the Horde says in chat LOL, and then BUR is the other one, burr. Somebody here says, why, when you speak on deflation, the focus seems to be around goods rather than core services ex housing, which remains sticky? Well, I suppose it depends on your definition of remain sticky, because we can kind of we can look at this. First of all, we can look at core, right? So here's just core, not ex housing yet, but here's core, and as you can see, year over year, there's no stickiness. Year over year, core PC is straight down. Multivariate core, which is the New York Fed's, interpretation of this, is that it's come down substantially, and that, now it's slightly up from its lows, but it's still lower than PC core. If we go to decompositions, we can actually go in here and we can pull out goods entirely. So it just eliminate the goods line. And so, in fact, even to help with this chart, let's just get rid of the multivariate core, because with multivariate core, you could see the giant plummet, and then it's come up a tiny little bit. Let's get rid of multivariate for a moment. There we go. So here we go. You said, what about services ex housing? Okay. And let me just put it up again. I just want to make sure what you said. You speak on deflation. The focus seems to be around goods rather than core services ex housing, which remains sticky. Well, I mean, personally, it depends on your definition of sticky. If your definition of sticky is, it's not as low as it used to be, which was around 0, well, then you're right. I guess it is sticky high. But if you're, looking at, it went up and it's not coming down, then you would assume it would still be up here. It's actually made substantial progress down. It's gone from 1.49% per month down like 67%. It's down 2/3. So, and I think when we look at the longer run, we can actually look at the 90s and see how long it really took for services ex housing to get down to 0. You could see that in the mid 2000s as well. You could see that, in the 80s, the volatility over here. So I'm not convinced that, core services ex housing really is coming down. Anyway, in response to this, Fitness Tech says, this is a fake rally. I'm shorting the pre-market. Oh, okay. Everything's fake news.
400,000 shares of volume. The athletic footwear retailer reporting better than expected profits and revenues, and sales declines at existing store locations were not as bad as expected. Foot Locker also forecasts full-year profits ahead of estimates as well, so those shares up big. And then we'll end on one of the original meme stocks out there. You guys kind of got a hint of it with Mike Santoli. GameStop is up a whopping, at this point, 13% Nothing really notable here, but it comes on over 1.2 million shares of trading volume just pre-market. It builds on yesterday's 13% gain on much heavier than an average volume. The action comes ahead of the video game retailer's earnings report next week on December 6th. And as some online discussion platforms see a pickup of mentions of GameStop stock. So
here we go. The memes are back. GameStop. Oh, the Jimmy. We got to start playing, boy. I just lost lots of money again. It's up 12% in the pre-market and 13% yesterday. Holy smokes. Look at GME. It's starting to pump again. Kevin, what would you say is the biggest risk when it comes to layoffs? Well, I don't really, okay, well, I have to be careful how I phrase this. I don't think it's layoffs that are the issue. It's net joblessness. See, because if you get laid off, let's say you're an engineer making $150,000 a year, and then you get laid off, and then you diddly doddly for 4 weeks, taking some AI certification. Then you apply for a new job, and you get paid $250,000 because you threw AI on your resume. Do you all of a sudden become a net negative or a net positive to the economy? So I think that answer is obvious. So the question is, in broad net, if people get laid off, can they go on to get the same or better of a job? And the net matters. Like, getting laid off for the economy does not matter, because then you'll turn around and make it your job to get hired again because you need income. So you turn around and go get a job again. Maybe you got laid off as a restaurant expediter, and then you go to another job and you become a server and you get paid 30 or 50% more. Anyway. All right. So big penny stock alerts. Wow, these are some quality alerts here. Futures point to higher open. Huh. Wow. Is it worth changing wall-mounted lights to pot lights or ceiling fans in a 5% down house? Why? This is a problem when people buy a house. Oh, somebody mentioned there might have been because the gold course went live, and somebody mentioned the how to buy your first home lecture. I may not have hit live on, or I missed the upload on that. So I'm going to make sure that it's either. I'm going to fix that. But we'll talk about first time home buyers, and we have a whole section on mistakes they make and noob decisions. But anyway, so thank you for those who brought that to my attention. So surprised we haven't mentioned we're less than $1 away from the yearly high of the SPY. Okay, well, yeah, that's point. That's a good point. Let's take a look at that. So SPX. All right. Huh. It's less than $1 away from the yearly high. Oh, the yearly high. Okay. All right. So the yearly high close. Well, I'm on the average candlesticks. All right, let's see here. So 4606. Well, we're close. I think maybe you mean like 1%. Yeah, you're right. We're less than 1% away from the summer high on the S&P 500. That's very interesting. We're just getting started. We'll see. Thoughts on Polestar? Yeah, every time I look at their financials, I don't jump up and down, I have to say. If the economy remains strong, as you believe, then core services ex housing would remain sticky and well above the Fed target. Why? Well, just because you say? Is that why? Because you have put that sentence together like this? Or are you asking a question? Because if it's a fact, I want to know how you have evidence that it's a fact, that just because a strong economy means core services is going to stay up. A. And B, if it's a question, I don't know. I don't think that's true. What is this? Charlie Munger speaks to the incessant, inconformant. Geez, Lord, are you like a PhD or something? What is this? Charlie Munger speaks to the incessant inconformity of human condition that one of the wealthiest men in history at 99 years still thinks of the failure of what could have been trillions instead of billions. And I'm taking a screenshot of that. Hold on, I got to get into the screenshot. Yeah. That, I mean, how eloquently put, good sir. Good sir. William Knight, good sir. I concur. Now, where are my crumpets? Basically, you just can never get enough. Yeah, that's good. That's good. What is the men's underwear index? Well, I've never heard of that, but I think it's funny. And I get like, are we gonna start transitioning here to shorter underwear to match the short shorts? I don't know. That's what I see. That's the problem I have. If I wear short shorts because it's comfortable and they're $18, it's like if you wear boxers, the boxers are longer than the short shorts. It's like, wait a minute. I don't think that's right. Okay. All right. Wait, I don't know what we're talking about now. Somebody's cheering Bitcoin up 140%. Thinking about selling my house as we are building a custom house. Oh, open up the wallet. Do I sell it and take the $150K in equity into the new home loan, or rent it and net $550 a month? So many options. No, you have the option to blow more money or to stay an investor. Those are your options. You do have a cute profile picture here with your partner here, or whoever that is. I can't really tell. It's a profile picture, but yeah, congratulations. Looks like y'all have your stuff together. Don't blow it. When you talk about services X housing inflation, what considerations do you give the health insurance adjustments and the changes made this year? Well, look, they've been talking about these changes to the health insurance calculation coming for over a year. And when you look, at the latest BLS CPI report, they give you a little bit of a heads up about that. Now, that's not popular on Twitter, as usual. Twitter's just headlines. I'm just not going to go there. Let me go. So, but here's what I read. So this is the BLS saying, following the recommendations of the National Academies of Sciences, blah, 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 BLS is improving the methodology used to calculate retained earnings in the CPI Health Insurance Index. Under the pre-October 23 method, retained earnings were updated annually without smoothing of the data. Under the new method, the BLS will update retained earnings every 6 months using half-year data and will calculate a 2-year moving average. So they're going to a 2-year moving average, beginning with October of 2023. And there will be a 6-month transition using annual data that has been averaged over 2 years. In May, we will begin to incorporate half-year rather than annual retained earnings. Anyway, so they're going to a smoother system. The problem is that led to a bizarre plummet, a one-time plummet here. Let me go to the detailed categories. All right, health insurance. Yeah, here it is. Okay, so first, look at this. This is the non-seasonally adjusted number. Very important. It is the year-over-year, not seasonally adjusted number. That is what Twitter is going ham over, okay? The seasonally adjusted number, which, mind you, is actually what we use on a month-over-month basis, is showing 1.1% up. So you're actually showing health insurance went up between September and October, although it was coming down in August to September. So you have some volatility here. But the point is, everyone on Twitter is like, oh my God, the CPI is rigged. Here's the proof, boys and girls. CPI is rigged. It's down 34%. Yeah, right. My insurance is down 34%. And so congratulations. You're using A, a change in mythology, and B, an unseasonally adjusted number, which we use the seasonally adjusted numbers to calculate inflation. And so congratulations. You have fantastic clickbait again on Twitter without reality. It's just, I guess it leaves me a job. it leaves me something to talk about. Because if the tweets weren't blatantly stupid, maybe I wouldn't have anything to talk about. Maybe I should be thankful of the Twitter world. Munger read, oh, dude, come on, it's too soon, man. Munger read that comment and died. Oh, from William Knight. No. Oh. Hypothetically, where would you put an extra 100K in January? Wow. Tea and crumpets. I mean, it depends a lot on your age and what you've got going on. You know, for some people, that's buying real estate. For some people, that's buying bonds who are getting closer to retirement. For entrepreneurs, that could be throwing money into the biz. You know? I mean, yeah. I can tell you all about throwing money into businesses. It's been expensive. Anyway. All right. So Munger talks about his life regrets. Do you have any regrets with yourself? Yeah. The biggest one that haunts me is that I didn't buy my plane in 2021 when I wanted to. And I bought it a year late. Yeah. So I guess that's not that big of a deal. It's pretty first worldy. Like in hindsight. That's pretty first worldy. It's probably the most extreme first world thing you could say. It's true though. I don't know why. It haunts me. So it's terrible. I resent you for bringing that up. Okay. All right. So, yeah. Oh, that's it. That's it. I'm taking because you brought that up, I'm taking a sip of this drink. Oh, apple juice. Okay. Let me have some coffee now to offset a little bit. Hey, that was from last night, okay? I just didn't finish it. So, GameStop's up 15% in the pre-market. Like nothing's down except for Okta, which is which they just had a data breach, which is not great because they're supposed to be the single sign-on platform and security platform, and I guess all their customers just got whacked with a little bit of a data breach. So real men drink whiskey through a straw. Shut up. Any thoughts on hedge funds buying large plots of SFR entire neighborhoods around universities? Well, you have to be careful. A lot of these are purpose built. And personally, you have to ask this. Is millennial money coming back as Graham reached out? That's a good joke. No, I haven't heard anything. But thank you for asking. So you have to think about it this way. Okay. So there's this obsession with people saying Wall Street should not buy houses, right? Like this person. Oh, hedge funds are buying entire neighborhoods around universities. Okay. So let me ask you this. When you go to college, should you have to buy or should you rent? Well, obviously, you're going to rent. When you move to a new city, should you have to buy right away or should you rent? When you want to go to a bigger house or a smaller house or go somewhere temporarily, or you haven't rebuilt your credit yet, or you don't have the down payment yet to buy, should you be forced to buy or should you have the right to wait? And see, without landlords, you can't rent. It shocks me, but I don't think people realize without landlords providing a service, which is a pain in the ass service to provide, mind you, without landlords doing that, you can't rent. So I think that's useful to remember. Which part are they playing now?
Anything you'd like to do?
Well, that's an interesting question. I am so old and weak compared to what I was when I was 96 that I no longer want to catch a 200-pound tuna. It's just too goddamn much work to get it in. It takes too much physical strength. So I don't know why I would have paid any amount to catch a 200-pound tuna when I was younger and never caught one. And now if give me the opportunity, I would just decline going. I won't even go out after them. There are things you give up with time.
You're pretty active. You've got a busy social schedule. You're on Zoom. You have breakfasts and lunch.
Well, I
lunches.
like it that way.
Yeah.
That's my idea of a proper old age for me. And I didn't plan it. It just happened. And when it happened, I welcomed it. I am very good at recognizing unfair advantages. And I got unfair advantages in old age the way I got unfair advantages in non-old age. And when they came, I just grabbed them. Boom, boom, boom. The one grab I never made was for a third wife.
Oh,
Too late.
Jim, I think investors really enjoying reviewing his life lessons, spending less than you earn, investing prudently, not relying on luck necessarily.
No, and I just think you can come back over and over again to his notion that you want to buy really great properties at fair prices. David,
no.
It's really emblematic of how great
I think he means companies.
he is.
Buy great companies at fair prices better than buying fair companies at great prices. That's the quote, not properties. Although I suppose that would be true for properties too.
Yes,
And taking one last puff, which was the early days of Berkshire, Munger said, no, let's buy the best.
Poor guy doesn't sound like he's like super enthused. It's kind of like, I used to be able to do more, but you're doing a lot more. Yeah, but I used to do a lot more. Good Lord. Sad. So they were like, Kevin, just quit Twitter. Didn't you, Tesla hodler, didn't you like delete all your stuff like the other day, like Twitter and Facebook and stuff? And I thought I saw you in the chat and you're like, I deleted all my socials. And then somebody replied to you in the chat and they're like, is YouTube not social? It was good. I watched that interaction. I'm pretty sure I was live. I can't remember if it was on the podcast or where it was, but I saw that happen. And I'm like, oh, that's funny. I didn't say anything about it then. Anyway. So family is wanting to move to Florida. Oh, I'm sorry. Is it a bad idea to buy real estate in Florida in the next 6 years? Yeah, that's a tough one. I've seen some what the parts that I look at in Florida. I've definitely been seeing some softening. But that was likely also at the same time of September, October here, where everywhere was seeing softening because rates were feeling like they were going to go up to 10%. Everybody was panicking again. So I guess it depends where in Florida. Some of the Airbnb meccas, I think, are getting hit a little harder. Kevin has never said it's a good idea to buy in Florida. Well, there are parts of Florida I would buy in blindly, mostly because I grew up in Florida, and so I understand Florida. I think. Let me see. I think now, if I go 13, let's call it a year. A year minus 16 is 15. 31. Yeah. Oh. I have just this year lived in California longer than I've lived in Florida. Just this year. 16 versus 15 years. That's crazy. I already adjusted out Germany. Somebody here said, I deleted X yesterday, tired of butts. Home has any physical object should naturally lose value as they are being used and materials decay, not grow in value. Well, I don't know that I agree with that. Because that is true when you buy a mobile home. And that's also true. So the house does depreciate, as you can see with mobile homes. They go down in value until you tear them down. And that's also true of properties in towns that are dying. So that is actually true. The difference is that real estate or land actually increases in value based on population trends, income trends, and desirability of location. That then encourages people to maintain properties better because the land value is rising. And so now you have a proportionately more expensive house on more expensive land. So absent population and demographic and desirability changes, what you're saying is actually true. Housing does depreciate. It's the land that makes real estate an investment, and that makes people desire to maintain real estate. So exactly, land does not decay. That's my point. Land does not depreciate. However, it can become less desirable. Schade, Deutschland, alles ist vorbei. Yeah, Ike, there's so much. You must be an AfD-Wähler. It's okay. I think my dad is too. I don't know. I'm still trying to figure it out. But yeah, there's a lot of frustration in Germany. Allgemein für Deutschland. I'm pretty sure that's what it is. Anyway, all right. What are we doing here? What's going on? What are the suits saying? All right. Let's see here. Higher for longer, no longer. Global bonds are set for their best month since the great financial crisis in 2008, buoyed by slowing inflation and dovish stance from Fed officials. You know, this is like a book. It's playing out just like a book. Inflation will prove to be transitory at the end. What a movie. You know, if it starts, here's your movie script. All right. The Fed will print a lot of money because of this virus that comes. And the real movie is actually the Federal Reserve, because it starts out with everybody loves the Fed because they gave everyone money. And they're like, don't worry, inflation will be transitory. Then everybody gets punched in the face because inflation doesn't end up being transitory. And everybody has to go through, economic and stock market hell for 2 or 3 years. And then all of a sudden, it turns out inflation was transitory all along. And we just go back to the heydays. What the hell? Yeah, we'll see. And we're not out of the woods yet. We're still in the movie. The movie's still playing. We're still only, 2/3 of the way through the movie. But people's predictions on the end of the movie are starting to drop. Yeah. Okay. It's kind of like when you watch a movie, like a Nicholas Sparks movie. What was the one where the girl made that song that's got so popular? There's a good one. What was it called? Lauren made me watch it. Oh, was it A Walk to Remember? I'm pretty sure that's what it was. And you're watching the movie and you're like, oh, this is too good to be true. And you get like, 2/3 of the way in, and then everyone's predictions start dropping. It's like, oh, I think I see where this is going. Yeah, this was the song. I'm going to get demonetized for this, but who cares? You heard this? All right, that's one. And then where did I get the chorus? It's a great song. It's a great song. Yeah, that was, I don't know why I'm bringing that up. But anyway, yeah, because it was the reference to the Fed movie. That's right. So we're at the prediction stage. Anyway, so you guys are assholes in the chat. Spoiler alert. Oh, that's funny. Okay, all right, let's go over here.
Has to be done in building relationships and being transparent with the regulators at the state, the local, and the federal level, as well as with first responders. So I think that was one of the issues as we move forward, and we're already building the relationship and leveraging the strength that General Motors has in this space of having a strong government relations team at all levels. And that's one of the things we'll do forward. From a General Motors perspective, safety is an overriding priority, and we always focus on transparency. So driving that into the cruise operations is a number one
Why don't I believe a word this lady says? So Jack could. Kevin, we watched Home Alone last night. Always reminds me of you.
As we go with this technology, we have to look at the fact that 40,000 people lose their lives and 90% of accidents and fatalities caused today are caused by human error. As we
You realize she's pitching Tesla here, right?
faster, but I think when we look at where it is compared, and there's been studies done as it relates to safer than a human driver, I think what we've learned in this, it's got to be much safer than a human driver.
Fair enough. I want to switch directions to something that hasn't been talked about that much, which is China. In 2018, your market share was 13.7%. Now you're at 8.6%. In the meantime, it's fair to say that between 2018 and what at least the first 9 months of 2023 indicate, your sales may have been in billions, may have been cut in half. Would it not be better to try to figure out what to do with China than just buy back shares? And what happens if President Biden says, you know what, cars cost too much money, let the Chinese sell cars here?
Well, I think a lot packed into that question there, but we have been working. I mean, I think there's a lot of change happening in China when you look at their rapid shift to electrification and the rise of a lot of domestic EV companies. I think there's still sorting that has to happen. There's over 100 companies, and many of them are not profitable. We are still in the high single-digit share perspective between our two joint ventures, and so having the right portfolio and participating where our brands belong in that market is something that we're.
This is exhausting. I have a hard time listening to this. Let me see if there's something else to cover.
So, and your second question, Jim, was?
Oh, just in terms of, I'm trying to figure out how much money, that money would be better spent there. I mean, because I'm trying to figure out how come your sales went down so much. And the sales are down substantially in terms of market share and in terms of amount of money.
Yeah, I think, though, if you look, there's been very much a structural shift with the domestic OEMs really gaining share and gaining consumer acceptance, which I think for several years prior, the markets were dominated by Western manufacturers. And with the shift to electrification, there's been a reset there. And again, when you have 100 new entrants coming into a market, there's going to be a shift. We think we're well positioned with our plan in China, and that was all factored into what we're doing and from the ASR. We think we have the right plans for each areas of our business that gave us confidence to do the $10 billion ASR.
Mary, it's David. Speaking of the consumer.
Oh, Google Maps, I guess, changed the colors of their maps. And I guess a lot of people are pissed about it. Like, go here, I'll pull it up. Tell me if you notice a difference. Hold on, I'll pull it up here really quick. This is very interesting. Oh, wow. Like, I had to blink a few times when I first saw it. I'm like, wait, what? Huh? What? Yeah, the earth color looks different. The highway colors look different. Anyway, see that to me is more entertaining than what I'm hearing here from GM.
Ups and downs, but with a overall trend of increasing from an EV perspective. And when you look at the United States, you've got to have the right EVs. The biggest markets are in that $30,000 to $40,000, or the biggest segments, are in that $30,000 to $40,000 price vehicle. We have the Bolt there that's done very well as we get more and more of our Chevy Blazer EVs and Chevy Equinox EVs into the market. I think we're going to be hitting a sweet spot with a vehicle that has no excuses. There's no sacrifices that someone has to make.
Let's see you try to make that profitable. Institutions actually believe her that they can get to autonomy and profitable electric vehicles.
Structure has to be robust as well. So I don't think it's that EV sales are going down. I think the rate of growth has slowed. And I think we're going to see variation as we move forward.
Mary, it's Phil again. How confident are you that you will get the issues when it comes to Ultium battery cell production fixed and you can ramp up production? Because that's the key to all of your guidance when it comes to EV sales and margins in 24 and 25. And frankly, it hasn't worked out so far in 23. How do you fix that and how quickly can it start to ramp from here?
Color out, baby.
Phil, I totally agree with you. This is very important that we get the Ultium-based products out. We'll have more in H2 of 23 than we had in H1, but next year is going to be a critical year. As we said, we think, we have more module capacity coming online toward the end of this year into early next year. That's why we feel we'll see improvements in H1, improvements in H2, and beyond that, we don't think modules will be a constraint. And a lot of learnings there that we've applied. And as I mentioned on the call, we've not only changed the process, we've also changed the team. So I believe that that's behind us, and I'm confident in our ability to deliver significantly more Ultium-based EV products. And these are products, again, that have no compromise when we look at what the customer is going to be looking for.
Okay. All right. This is so exhausting. I'm sorry. You know what we're going to do? We're going to go listen to a piece instead. By popular request, actually one person asked for this, but it's better than this. One person said, any juicy bear pieces right now? Sure. Let's go to our favorite Wall Street bears. The Wall Street bears who basically capitulated during the summer rally and said, well, we're going to go long some stocks because of FOMO. And I respect if somebody could say I was wrong, but it was just bad timing for the resident bear. That's all I got to say, because then things started getting bearish for 3 months. That was the sign. That was the sign when and I should have seen it. So I messed up too, but I should have seen that when we were in July and TS Lombard starts buying stocks, and who was it? Mike Wilson at Morgan Stanley says he was wrong. That right there was the top. When the bears capitulate, that's when you're at the top. All right. So what do we have here? So it's the sentiment that counts more so than the economy. A November consumer sentiment tracked by the Conference Board was released, and the spread between present and future expectations points to recession. Perhaps one is already underway. Doubtful, though. Overall sentiment has increased, but because of an unusual downward revision of the October number, the November number seems suspect. Any number below 100 should make the White House more nervous than recent polling. Okay, blah, blah, blah. So where are we going with this? This disassociation has been underway for over a decade at least. Perhaps we are measuring the economy all wrong in terms of understanding of how people see growth intersecting with their lives. I feel like this is kind of like a little bit of a cop-out. Like, yeah, you know what? It's the data that's been wrong. It's not us bears. We're just relying on the data. That's not why we've been wrong. It's because it's not the interpretation of the data. It's the data. If you look at Bloomberg, they did a piece on economists flying blind, I think was their piece. Yeah, it's basically the same thing. They just posted this like, I don't know, a week ago or something like that. I don't know why I remember this article title, but they ran this opinion piece. Former Fed Reserve economist. Economists may have been flying blind all along. Basically talks about how bad the data is right now because the surveys are nonsense and not very reliable because the response rates are super low. And so let's see where they go with this. All accounts, social ills were a lot worse in the 60s and compared to 68. Then you have high sentiment. Okay, this real income soared post 2009, but trust in government never recovered. Ooh, that's a good line. Perhaps low inflation and rising real incomes is less meaningful than getting raises. We know that the past decade we saw a record percentage of people getting no nominal raises for a year's work. Income distribution steeper now. Lack of trust in the government. Okay, well, this is the latest we got from TS Lombard, talking about there is more to do in determining why Americans feel less good than they did in 1968, a year that was decidedly less stable. Wow. I'll get some more bear pieces for us. But let's get the bell, although they're not even back yet. Should be back here any second. Come on, baby. Give me the bell. We got the ding-ding to get to. All right, here we go.
Opening bell in the CNBC Real-Time Exchange. At the big board, it's Build-A-Bear Workshop at the NASDAQ. It's Bank Holding Company, West Banco, headquartered in West Virginia. As we mentioned, Jamie Dimon talking to Andrew Ross-Sorkin at the Dealbook Summit right now. Andrew began by asking why Dimon views it as a dangerous time. Here's what he said.
Again, welcome everybody. If you look at history and you open a newspaper of any month of any year, of course, there's always tough stuff going on, wars and depressions and recessions. But if you look at this time, and what's happening in Ukraine, a 600-mile front, a free and democratic European nation, 600,000 casualties, huge humanitarian crisis, NATO on the border of NATO, nuclear blackmail, and it's affecting, all oil and gas, migration, food costs, and all international military and economic relationships. That's pretty tough. And that was before the terrorist attack in Israel. And so I look at those things as it's dangerous. And we need to get through it. Now, hopefully, it'll all go away. But if you look at the history of battles like this, they're unpredictable. You don't know the full effect. And so, and I've spoken to a lot of people. I think you've talked to Condi Rice and Bob Gates and some of the military folks. They would say the same thing. This is really complex, and obviously it's affecting America and China.
America, who? Anyway, take a look at stocks. We've got Enphase up 2.71%. Folks, we're about to get critical on Enphase. Look at this. You do not have to be a technical analysis whiz to look at these delicious yellow lines and go, wow, that looks like the perfect stock to lose money in. Well, you would have been correct. These lines were so delicious. But what you're also about to notice is the following. You ready for this? Look at this. We're almost there. We're almost there. What happens when we break that yellow line? We'll probably go all the way to zero. Theoretically, that should be bullish, breaking this line right here. That would be about 105, 106, depending on how quickly that breaks. So TBD. Holy crap, GameStop. What the frackin' smoke is going on over here? Oh, the meme rally is back, baby. We're back to 2021. Where's the green hair? Why didn't he keep the green? He should have kept the green hair. He should have kept the green hair. He was right again, but he flip-flops. He flip-flops. He thought he'd have a reset. A channel reset, and we should have kept it. It was obvious. He did the green hair. He did the right thing, and then he went he flip-flopped on it. Anyway, 2% here on Tesla, Intel, another 1.2%. Nvidia, we got 1% over here. We've got Intuit up 3.8. I guess I'm just not going to be able to buy this damn thing. CrowdStrike up 5%. Matterport's coming up. Palantir's over 20 again. Let's see. Apple, 86 basis points. It's just driving our indices up. Microsoft, 20-something. Etsy up. We've got Bitcoin sitting at 38. Ulta's up 1%. Trade Desk back over 70. There's Enphase still sitting with its 3%. Let's see what happens. Caterpillar, John Deere, the industrials are going up. This is broad-based. I mean, you've got retail, you've got consumer discretionary, you've got restaurants, you've got technologies, you've got crypto, you've got everything up. You've got C3 AI is up. Open Doors up 5%. Roblox. How are they still $40? I swear they've been $40 for like 10 years. They haven't been public for 10 years. But zoom out. Yeah, look at this. Look how long they've been here. Here, let's go to the week chart. They're always around $40. It's crazy. I got to reset these fibs. That's ridiculous. Whatever. All right. What else? Affirm up another 3%. GameStop. Jeez, Lord. Look at all the meme orders came through. I wonder if this was options buying. It's like options buying at the order. Market makers are like, oh, Intuit up 4.5 now. Hey, this is pretty cool. Somebody says PayPal's going up. That's great. Somebody here, by the way, I wanted to shout this out. Appreciated this. Where was it? They said, where was it? Basically, they said they bought calls because of my analysis on Intel, and they made money, and then they bought the gold course. And I wanted to say thank you. Oh, here it is. Thanks for the free course. I bought Intel calls and I'm up 220%. Let's go. That's freaking awesome. So congratulations, A. And yeah, the we haven't changed the Cyber Monday sale yet. I think that's sort of roughly turning into like a Cyber Week sale. We did change the Black Friday, but yeah, I gotta update that. This has been so busy. Anyway, okay. So what else? What else is news? Let's see what the 10-year is doing right now. Let's find out. All right, the 10-year. Oh yeah, baby, 4.28 down 5.6 bips. Let's look at the 2-year. The 2-year's down 8 bips. Let's go. Bullish steepening. Yeah, it is. That's a bullish steepening. Okay. All right, I like that. I'll take it. The snowball is beginning. I like it a lot. So the next thing is, oh, they have more Jamie. Let's listen to Jamie.
I think 9 or 10 million barrels of oil a day. So every country is going to be looking at its own national security interests. And so the complexity of China will work that. We want to be we want to be at the table and help figure out. And I think the government's talking about the right way. Narrow garden, high walls, semiconductors, 100% of our penicillin, 100% of our pharmaceutical parts come from there. Obviously, we should fix that.
But is there any part of you that says, for example, doing business with ByteDance, with TikTok? We're going to have Kevin McCarthy on. He's not a fan, as you know, of TikTok. There are a number of states that are trying to ban TikTok.
I'm not going to go through it here, and I'm not going to talk about clients. You can imagine the due diligence and work we do to figure out what the truth is about those things. If some of those people are doing things that we think are truly bad, we would not bank them. And
ooh, what a little mic drop there. Damn it, Intuit. Damn it. I was saying yesterday, I want to buy them. I like them a lot. No! Stop! Oh, damn it. Look at it. It was right below the fib. I had my chance. I had my chance at this fib too. And I'm like, no, I need more down. Damn it. Oh, well. All right. Wow. Okay. This is cool. So, okay. Treasury yield's still falling. 4.27. Looks like people are going in their Treasury direct account and they're going shopping. So let's see. We have the Beige Book coming out at 11 a.m. today. That's going to speak to market conditions that we first heard. I don't know. Yeah, that'll speak to market conditions that the Federal Reserve saw going into the last Fed meeting, November 1. Obviously, it's a little hindsight-ish right now, but whatever. So let's see here. Bill Ackman's betting that rates are going to get cut. Of course he is, because he probably covered all his shorts. In fact, I'm pretty sure he did. I remember a tweet. I saw some tweets where people are like, oh, Bill Ackman's no longer short. I'm like, of course. Of course. Perfect at playing this manipulation game. Anyway, stocks climb on Goldilocks signals, say the suits. Stocks extended one of their biggest November rallies on record. Amid speculation, the Federal Reserve will be able to pull off a soft landing as the economy remains fairly strong and inflation begins to show signs of cooling. Boy, if we get a bad inflation report coming up here, we're screwed. PCE inflation comes out on the 30th. That's tomorrow. So tomorrow at 5:30 a.m. we'll be live and we'll cover PCE inflation together. Then we have continuing claims coming out at the same time. On the 1st, I can't believe it's already December 2023. I don't know what happened to this year. It feels like it evaporated. Now then again, time has gone by so fast. I feel like during COVID, I now have a child who's devastated. He's nearly 2 digits, and I'm like, bro. He's like, Dad, I'm getting old. I'm like, dude, you're 8. The S&P 500 approached 4,600 in an advance that sent the benchmark up almost 10% this month. 10% this month for the SPY. That's like straight up. Yeah, look at that. It's up another 0.6 right here. Oh, yeah, look at that. Basically breaking through the highs of the summer here. That is straight up. Boy, yeah, look at that. Somebody says Affirm is mooning, and somebody else says here for my daily dislike. Well, appreciate you for engaging. Thank you. Yeah, Affirm up now to another 5% to 34. Wow. Wait, SMH, the semiconductor ETF, is easy money. You know who just shorted that? Michael Burry. Michael Burry just shorted, I'm pretty sure, in his last filing. Michael Burry, semiconductor short. Yep. Michael Burry acquired puts against with 100,000 shares of the semiconductor ETF SOX. Oh, poor bastard. SOX puts now account for 47.8% of Michael Burry's portfolio. And that was as of September 30th. Well, September 30th would be around here. Yeah. Rip. I mean, unless he closed his shorts here, you know, he had a chance of making a profit. But if he's still holding on to that, somebody call a doctor. We're going to need a welfare check. Okay, so what else? Gross domestic product was revised up. We saw that, 5.2%. But that's Q3, so it doesn't really matter. Current Atlanta Fed GDP is looking at 2.1%. Investors seem much more focused on inflation. There's been a half glass empty attitude, leaving a lot of money on the sidelines. But now that's starting to flip-flop. Nobody knows. Nobody knows. Unhappy consumers will welcome a slower economy. Okay, I don't know about that. And Black Friday sales seem to continue to pump there. SoFi to exit crypto. No way. Now that is news. I gotta read that. Hold on. Somebody says, oh, wow, GameStop went from up 20% to now 10%, and now Foot Locker took the reins. How fascinating. Okay. Enphase, yeah, 102. Still got some work to do. Tesla up another 2% here. All right. So what's going on with SoFi? SoFi, fastest growing one-stop shop for financial products, is exiting crypto, even with token prices surging because of increased scrutiny by banking regulators. That's true. They got their banking charter. The San Francisco-based company told crypto customers Wednesday they will need to liquidate their accounts in coming weeks or move to crypto exchange and wallet provider blockchain.com. Wow. Fed says it's stepping up scrutiny of lenders involved in digital assets. Yeah. You put crypto on your SEC filings, you get the highlighter. It's like basically like, all right, SEC, let me bend over. So if you want to avoid that, don't. I wonder if that's why Coinbase is falling. Sorry, that's the VIX. Coinbase. I mean, it's done fantastic. Don't get me wrong. It's done incredible. It's only down 1%. Who cares? Oh, yeah, we're actually going to do an analysis on Coin today. How interesting. I'm looking at our schedule for our course member live stream. FICO and Coin is the analysis we're doing today. How fascinating. That's great. Yeah, I mean, this isn't really going to have an impact on Coin, but it is interesting regarding regulation because, you know, it potentially gives more power to a company like Coin, actually. Anyway. It's that time. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Yeah. I don't know. I love that. I love the music. Do Gold Course members get the live stream? Hell yeah. It's a freaking bargain. I'm adding more content to it, by the way. Tag me in Discord. But basically, some people are mentioning that either A, there were a couple things that I forgot to upload, or B, a couple things I forgot to address. And so I'm making a list of even more content that'll be added to the Gold Course. That's one of the things with me is I like to keep adding content, and I still have work to do to go back into some of the OG courses as well. So there's more work to do. It never ends. So I go in these like sprints. You know, I'll make a list and then I'll do like a hard recording sprint, and then I take a break. So there'll be more. So we'll take care of that. And actually, Daniel G saying, not sure if you have these up, but it would be awesome to have a business course on how to get started and the tax benefits of having a business. That's literally what's in the Gold Course. Just out. I mean, there are massive lectures on tax benefits and entrepreneurship over there. It's really good. And there'll be more content as well. Anyway, thank you so much. See you in the next one.